Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We have some exciting topics lined up for you. We'll dive into India's plan to offer capital gains tax relief for foreign bond investors, a move that's sure to impact global investment flows. We'll also discuss the growing demand from market participants for the Reserve Bank of India to prioritize the rupee and whether the Monetary Policy Committee will align with these expectations. We'll also cover Kelton Tech, whose financial year 26 profit has hit an impressive rupees 91 crores, leading to their rating being upgraded to A-. Lots to unpack today.
That's right, Vijendra. Starting with the tax proposal, India plans to remove capital gains tax on foreign portfolio investments in government securities, currently 12.5% for holdings over 1 year, plus a 20% withholding tax on bond interest. This aims to boost foreign inflows amid a 5% rupee depreciation. Globally, India is unusual in taxing non-resident debt flows, and removing these taxes could marginally increase foreign investment in government bonds, helping stabilize the rupee and debt market amid external pressures.
Foreign investors have still pumped in $1.4 billion in government debt this year, despite nearly $28 billion exiting equities. India's East investment norms and inclusion in major global bond indices support this trend, with Bloomberg delaying India's inclusion in the Global Aggregate Index until June. This tax relief could improve India's chances, attracting more foreign capital and strengthening the rupee further in a challenging external environment.
Another major topic is monetary policy. 71% of market participants want the Reserve Bank of India to prioritize supporting the rupee and forex stability in the upcoming Monetary Policy Committee meeting. The market sees currency stability as crucial amid global uncertainties. At the same time, the Reserve Bank of India has to balance inflation risks and liquidity conditions carefully because these affect growth and credit transmission in the domestic economy.
Exactly. Experts like Mr. Ejita Bhatti stress that food price volatility and core inflation momentum mean disinflation is not steady enough for easing. A cautious hold with vigilance on inflation surprises and external shocks is therefore likely. Commentary on liquidity and future policy direction will also be key because stable rates and supportive liquidity help maintain confidence, especially in sectors like real estate that depend on steady funding conditions and consumer demand.
Moving to the corporate space, Kelton Tech posted a profit after tax of 91 crores in financial year 26, with revenue at 1,225 crores rupees. Their credit rating was upgraded to A-, signaling improved financial strength. That upgrade should lower borrowing costs and boost investor confidence. However, geopolitical risks slowing receivables and sales in the United States could pressure near-term cash flow.
Kelton is also pivoting to an AI-first model, launching products like Phoenix.ai for ERP modernization and partnering with Microsoft and Snowflake to drive digital transformation. This AI focus aligns with mid-cap peers and could differentiate Kelton, but execution and managing delayed projects will be critical to sustaining growth amid macroeconomic headwinds.
Another important development comes from Patel Engineering. Infomerics has upgraded Patel Engineering's long-term rating from A- to A and short-term rating from A2 plus to A1, effective June 3, 2026. This signals improved financial stability and creditworthiness. The upgrade improves market credibility, enhances access to capital markets, and positions the company well to secure larger infrastructure contracts amid competition from peers such as Larsen & Toubro and KNR Constructions.
Patel Engineering's focus on strengthening the balance sheet and cash flow management has been key. However, execution risk on bigger projects remains critical to sustaining this positive rating shift. Investors should watch how Patel translates the upgraded rating into actual project wins and profitability over the coming years. Meanwhile, PTC Industries reported revenue of Rs 643.3 crores in fiscal year 26, up 88%, with profit after tax reaching Rs 101.6 crores, a 66.4% rise. That reflects a strong shift to scaled execution, particularly in aerospace and defense, supported by advanced forging systems, machining capacity expansion, and strategic partnerships including Blue Origin.
Continuing with PTC Industries, that growth aligns with market trends favoring specialized aerospace forgings. The addition of advanced forging and machining systems enhances capacity, making their upgraded credit rating to A stable by ICRA well-deserved and promising for sustained profitability. Their new 4,500 to 5,100 ton intelligent open die forging system and second Makino G7 machine in the United Kingdom are key drivers, while strategic partnerships, notably with Blue Origin, support long-term supply contracts. Investors should watch utilization of these assets closely, especially with risks from geopolitical factors and aerospace demand. Yet, PTC's outperformance against industrial peers highlights the strength of their focused approach in complex forgings.
Moving to another corporate update, Sandhar Technologies secured ICRA ratings for Rs 885 crores of debt, with long-term loans rated AA- stable and working capital facilities rated AA- stable and A1+. These ratings reflect low default risk and robust liquidity, supporting lender confidence. In the automotive component sector, such ratings can reduce borrowing costs and enhance market standing. The rating covers term loans, unallocated facilities, and working capital, demonstrating comprehensive financial discipline, although investors should continue monitoring quarterly results and future ICRA updates.
iFinance is also in focus. The company plans a working committee meeting on June 8, 2026 to discuss issuing senior, secured, listed non-convertible debentures worth up to $15 million through private placement. This aligns with broader market trends where listed senior secured NCDs are used to enhance liquidity and investor confidence. The issuance depends on committee approval and regulatory compliance, while the capital raised could strengthen financial resources and potentially support growth or refinancing of existing liabilities. Timely disclosures under Securities and Exchange Board of India regulations further reinforce transparency.
Staying with fundraising activity, IdeaForge Technology has received board approval to raise up to Rs 500 crores through equity preference shares or convertible and non-convertible debentures. This flexibility allows the company to balance dilution and debt depending on market conditions. Given that the unmanned aerial vehicle sector requires substantial investment in research and manufacturing, the proposed fundraise could support growth and product expansion. The next steps include shareholder approval through postal ballot and regulatory clearances, while the fundraising committee will oversee execution details such as pricing and timing.
Let's turn to the debt market. The Reserve Bank of India rejected bids for 182-day and 364-day Treasury bills, showing firm resistance to rising yields despite strong demand for 91-day bills. This signals stress in the government borrowing program as investors demand higher risk premiums. Market instability is playing a major role, with the Indian rupee nearing 96 per US dollar and 10-year bond yields moving above 7%. Investors appear to be shifting from yield-seeking behavior toward capital preservation amid tightening liquidity and geopolitical risks.
Exactly. The reluctance to accept longer duration bids reflects concerns about duration risk and inflation. Mutual funds continue to support ultra-short-term bills, but reduced participation in longer maturities could contribute to tighter credit conditions if banks become more cautious in lending. With 2 auction cancellations already occurring during this fiscal year, the divergence between official yield targets and market expectations is complicating monetary policy, particularly amid uncertain monsoon forecasts and escalating global trade tensions.
Moving to hospitality, Ventive Hospitality infused 50 crores rupees into Soham Leisure Ventures through subscription to 50 lakh optionally convertible debentures on June 3, 2026. This follows earlier subscriptions totaling 135.5 crores and demonstrates continued commitment to the Hilton Goa resort operator. Although Soham Leisure's turnover slipped to 40.66 crores in 2026 after a modest increase in the previous year, Ventive's 76% ownership stake since October 2025 strengthens its influence and indicates confidence in the long-term potential of the business.
Another significant trend is the sharp decline in additional Tier 1 bond issuances. The market raised only Rs 3,500 crores in 2025, representing a 79% drop from Rs 16,859 crores in 2024. Investor confidence has been affected by scandals and write-offs, while these perpetual bonds continue to be viewed as relatively high risk. As a result, banks are increasingly favoring additional Tier 2 bonds, which offer fixed redemption features and are considered safer by investors.
Public sector banks had traditionally dominated 81 issuances, with State Bank of India alone raising 42,208 crores rupees across 9 issuances since 2021. However, even large issuers have reduced activity amid regulatory uncertainty and weaker investor appetite. Looking ahead, recovery in the AT1 market will likely depend on issuers offering spreads that adequately compensate investors for the risks involved, particularly among AAA-rated banks, where stronger balance sheets could gradually restore confidence.
Finally, yields on AAA-rated corporate bonds in India have now crossed 8%, the highest level since early 2019. This rise, particularly across 2-year to 5-year maturities, reflects expectations of further Reserve Bank of India tightening and reduced liquidity. Borrowing costs have increased enough to delay corporate bond issuance, while companies increasingly prefer floating rate instruments, short-term debt, and bank loans. Credit to non-banking financial companies surged by nearly 28% in April, reaching rupees 20,560 crores, highlighting a broader shift in funding strategy. That trend is reshaping how Indian companies approach debt management as markets prepare for a more challenging interest rate environment.
Turning now to international finance and alternative investments, Cube Research and Technologies from London is establishing a Category 3 alternative investment fund in Gift City, India's international financial services center. This makes it the first global high-frequency trading firm to register in the special economic zone with full tax exemptions on derivative gains. Unlike firms operating in the domestic tariff area, Cube benefits from exemptions on income tax and securities transaction tax, significantly improving cost efficiency. Section 104D of the Income Tax Act provides legal clarity by exempting income for eligible Category 3 AIFs in IFSCs when earnings are received in convertible foreign exchange. With growing high-frequency trading activity in Gift City, this move could strengthen the ecosystem and enhance India's attractiveness as a global trading hub.
Another major capital market story comes from IIFL Finance, which plans to raise at least $400 million through a dollar bond with a tenure of 3 years and 3 months. The targeted coupon stands at 7.60%, down by 30 basis points from the initial guidance. Strong investor demand with bids around $1 billion highlights confidence in the offering. The bonds are secured by receivables and assets, while Fitch Ratings has assigned an expected rating of B+. The transaction helps diversify funding sources and supports IIFL's goal of increasing external borrowings from 13% to 20% of total debt.
In the banking sector, lenders are reporting a 1.74% non-performing asset ratio in self-help group loans as of March 2026. Fraud and multiple loan exposures remain key concerns, leading banks to push for unique registration numbers integrated into core banking systems for real-time verification. They are also advocating for a central registry to cross-check self-help group credit data across institutions and share information with credit bureaus. Combined with government portals and community-based recovery efforts, these initiatives aim to improve transparency, strengthen credit discipline, and enhance recovery rates across the sector.
Currency markets remain under pressure as the rupee opened at 95.70 against the US dollar, gaining only 1 paise. Foreign portfolio investors have withdrawn nearly $600 million in a single day, bringing total outflows to roughly $3 billion across 4 sessions. Rising crude oil prices, up nearly 2% following attacks near the Strait of Hormuz, are adding to inflationary pressures and increasing demand for US dollars. As the Reserve Bank of India's Monetary Policy Committee prepares to meet, analysts expect a hawkish stance, while technical resistance for the dollar-rupee pair is seen around 95.90 to 96.00.
The Finance Ministry has meanwhile directed 12 public sector banks to strengthen provisioning buffers for retail, MSME, and agriculture loans due to rising stress indicators. Special mention accounts now total roughly 4.03 trillion rupees, while retail SMA ratios remain elevated at 6.17%. The move also prepares banks for the expected credit loss framework beginning in fiscal year 28, which will require provisioning based on future expected losses rather than only existing impairment. Alongside this, the government is expanding Emergency Credit Line Guarantee Scheme 5.0, providing rupees 2.55 trillion in additional support, including rupees 5,000 crores earmarked for airlines.
Indian banks continue to demonstrate strong capital positions. Kotak Mahindra Bank leads Asia Pacific banks with assets exceeding $100 billion, reporting a leverage ratio of 16.56% as of March 31, 2026. Private sector peers such as HDFC Bank and ICICI Bank also maintain leverage ratios above 10%, far stronger than many regional competitors. Among state-owned lenders, Union Bank of India recorded a 69 basis point improvement to 7.72%. Meanwhile, RIC Limited plans to raise up to rupees 3,000 crores through bonds carrying a tenure of 2 years, 8 months and 18 days. Supported by AAA ratings from CARE, CRISIL and ICRA, the issuance is expected to attract strong institutional participation and reinforce REC's position as a major issuer in India's domestic debt market.
Looking ahead, Gift City continues to expand its role as a global financial center. The International Financial Services Centers Authority has introduced Pension Fund Regulations 2026, requiring a minimum track record of 10 years and strengthening governance standards for retirement-focused investment products. At the same time, Nippon Life Insurance plans to invest up to $9.4 billion in private credit managed by Blackstone over 5 years, reflecting a broader shift by Japanese insurers towards alternative assets. Blackstone may also manage a number of Nippon Life's urban properties, extending the partnership into real estate. Closer to home, the Reserve Bank of India has denied reports of gold sales, confirming reserves remain at 880.52 tons. Finally, EEPC India is urging the government to create a dedicated credit rating framework for micro, small, and medium enterprises. With MSMEs contributing nearly one-third of manufacturing output and about 45% of merchandise exports, a specialized rating system could improve access to finance, strengthen competitiveness, and support long-term economic growth.